We are entering into an easy money time period. We've got interest rates going down. We've got the Fed transitioning from quantitative tightening to quantitative easing, and we've got government spending that just won't slow down. And all of this leads to subsidizing loss and protecting failure. In order to have a thriving economy, you need to have the things that lose money eventually fail and be forced to stop. For example, let's say you have a personal budget where you spend way more than you earn, and you spend your money on all the wrong things. You're just consuming. You're not purchasing any investments. You're not buying skills for yourself so that you could make more money later on. You're just spending to spend, and way more than your income. The only way you can do this is for a short period of time if, number one, you have previously saved. But at some point you run out of that, which means to continue, you can only do that by borrowing from somebody else. But at a certain point, every lender will realize that you won't be able to pay it back, so they will just stop lending you money. This is the person who maxes out their credit cards, has auto loans, and then they can't pay those, so they start leasing. They've got a personal loan, they've got a mortgage and a home equity line of credit and a second mortgage that they used to pay off their credit cards before. They're maxed out across the board. They just can't get any more debt now to keep this game going, so they declare bankruptcy and they cannot borrow anymore, at least for a certain number of years. In other words, financial loss and failure means that eventually that wasting comes to an end. The system prevents that leaky hole from continuing to leak wealth, destroy wealth. This is a good thing. Now, let's look at the opposite example. Let's look at somebody who works hard, they increase their skills, increase their income, they produce a lot more than they consume, so they have a high savings rate, and they use that to invest. And they are really good at investing. They research companies, they research their houses or their buildings, and they are looking carefully into it. They are purchasing good deals at good values. They're acquiring ownership stakes in assets, and those assets end up producing more real wealth, more goods and services in the real economy. And so they become worth more and more. As a result, this person who makes really good investment decisions is able to have more wealth at their disposal, more capital that they can use to make larger investments with. In other words, the successful capital allocator is naturally rewarded with more capital to allocate because they are good at it. And by good, it means they make more of it. The system naturally gives more resources to the person who can create more and more wealth. This is a good thing because without that, we wouldn't have any of the stuff that we want and need today. Now let's take a look at the money side of the equation. Imagine for a moment there's a fixed supply of money. The total amount of money cannot be increased or decreased. Let's say I want to borrow some money in order to go make an investment. And let's say for the last couple of years, everybody has been saving a ton of money. So the savings pool is large. Well, I'm going to go from one person to the next, asking them what they are willing to lend to me at, because I am a borrower competing for a lot of lenders. So I'm going to pit them against each other. And if any of them want my business, they will have to offer me a better interest rate or better terms than the last one, which means that any lender is looking at their pile of money, their savings, and thinking, man, I can't really make a lot on this. So the incentive here is to go out and invest and spend it. It's not doing me much good to hold on to it. So when the savings pool is large, the interest rate is low as the lenders are competing for borrowers, the incentive is to invest and spend. Now let's say the pendulum swings the other way. All the savers and lenders spend and invest and borrow because interest rates are cheap. The incentive is to borrow. And now the savings pool has been depleted. Everybody has spent, everybody has borrowed, everybody has invested. Well, as borrowers go around trying to borrow money, there's not going to be that many people who have savings anymore. And there are a lot of borrowers. And so all the borrowers now are competing for the few lenders, which means interest rates are going to be really high because the few lenders that still exist can just basically say whatever terms they want, and they're gonna get a borrower that's going to accept those terms. Now, these high interest rates mean everybody, all the borrowers and spenders are looking around and thinking, man, I could make way more money if I just saved right now. There's not a lot of reason to risk and borrow and spend right now. I can just save, become a lender, and make a really high rate of return on my money. So when the savings pool is depleted, the natural incentive is to save, is to lend. It is to not invest and not spend. So in a fixed money supply, the interest rate is just a signal of the cost of capital that tells investors, spenders, economic actors whether or not they should be saving or spending, whether or not they should be borrowing or lending. And that signal also acts as an incentive to keep the savings pool somewhat in balance. As interest rates rise, it refills the savings pool. As interest rates go down, it drains the savings pool. So not only are interest rates the signal that tell economic actors what they should be doing with their money, they also act as the incentive to make sure that it happens so that we don't get massive boom-bust cycles. Now enter into the time period where we live today, where somebody is just controlling what those interest rates are. Those signals are still real. When interest rates go down, why keep the money in your high yield savings account? You're getting 0.01%. You're gonna have to go out and invest it. But that doesn't necessarily mean that the real savings pool is large and abundant. It just means that the signal being sent to you is that it is large and abundant. And the incentive being given to you is that it is large and abundant, which means that almost certainly you will have over-investing and an over-draining of the real savings pool, because the signal being sent to economic actors is false. It's artificial. It is imposed and created by the central bank. And the opposite is true as well. When the central bank is raising interest rates, they're doing so to try and get people to stop spending and to save, which means that there's a very high likelihood that people overspend, that people overlend, and that there is a bust and a recession as a result of people just saving too much because the incentive and the signal being given to them was to not spend and not invest. Now, we are right now entering into a time period, like I said at the beginning, where we have interest rates going down, quantitative tightening coming to an end, quantitative easing coming around the corner. We've got a federal government that just keeps spending and borrowing money into existence. This is an easy money environment where we have the economic signals being sent to economic actors artificially low. In other words, we are all being incentivized and told to spend and invest and borrow. One of the results of that is that you end up lowering the threshold for a return on your money. If I can only get 0% in the bank or 2% by lending it to the US government, then I'm okay with getting a 3 or a 4% return investing in stocks, because at least it's better than the alternative. That incentive is pushing all the capital into something with a subpar return in a real world environment. The effects of this over the long term are devastating because, number one, usually that's not even enough to make up for inflation, which means in real terms, you have a net destruction of wealth going on. The artificially low interest rates pushing that money into bad investments means wealth is being destroyed when you account for inflation, when you account for the loss of purchasing power. The second thing is a lot of money gets forced into companies that don't have to produce really stellar returns anymore. Companies that would be bankrupt otherwise now have floods of capital coming at them, even though they can only produce a 3%, 4% return, which is negative in real terms. Which means that not only are the investors losing because they're being forced or tricked into investing in companies with a negative real return, but also the companies themselves are also destroying wealth because that is subsidizing their failure to continue to waste wealth. Just like if interest rates go down and the lenders of the credit card company were to just continue to lend to you and let you continue to waste and spend and spend. This is the idea of the zombie company that exists because they were able to access artificially easy credit for years and years and years on end, funding loss, funding revenues that were less than expenses, funding products that cannot turn a profit. And so when you see valuations at record levels, when you think, how in the world are people investing at these crazy prices? That's the reason. Both the incentive and the signal being sent to investors is to go out there and subsidize loss and failure, because at least it's a little bit better than saving. And I think we are about to see a lot more of that over the coming quarters and years. I think there's a good chance that this means we will see bubble dynamics like we have not seen before. It'll make the dot-com bubble look small in comparison in terms of valuations and prices. Certainly there will be volatility and probably a future crash from it as well, but usually that happens once the tightening starts, not right as the easing is beginning. But I could be wrong, so don't take this as investment or trading advice. As always, thank you so much for watching. Have a good day.